Well, hi, it's Rob Miller from Pacific Residential Mortgage with my three-pointer of the week, another installment of my weekly video series where I touch on 3 points related to the housing and mortgage industries to keep real estate agents informed and better equipped to serve their clients at the highest level. Point one, do you have clients that are in the contingency dilemma? They have a lot of equity in their current home, but they can't access it until they sell, but they don't want to sell before they find a replacement property, so they come to you and say, let's write a contingent offer. And we all know how well-received contingent offers are in our current marketplace. Well, I may have a product that will solve this problem for you. It's a cross-collateralized loan program, and it works very similarly to a bridge loan. It allows your clients to leverage the equity in their current home for use on their next purchase without having to sell first. So it's a very nice solution. Now, not every client's going to qualify. It does require a fair amount of equity in the departing property, but for those that do have a lot of equity, it might be a really good solution to avoid having to write a contingent offer. So if you think you might have a client that qualifies, give me a call. We can go through the numbers and make sure it works. If nothing else, we can have a conversation about how the program comes together, and we can keep that in mind for future transactions. Okay. Point two, talk briefly about mortgage rates. We did experience a bit of a jump in rates at the beginning of September. I think I mentioned in a previous video, they ran up about 0.25% over a week's time, which is a pretty sudden move. However, we have seen things kind of calm down. Rates have been kind of in a flat holding pattern for the last couple of weeks, maybe improving just slightly. So again, it's an excellent time for any of your clients to be financing real estate. Certainly is not a deterrent in the current market to be buying a home. And finally, I thought I'd talk a little bit, have some fun with abbreviations and acronyms. We sure have our fair share of those in the mortgage industry, and because we interact so much with the federal government due to all of their oversight and regulations, we get to utilize a lot of theirs as well. So I'll share with you a few of the more common ones that you might encounter when discussing a mortgage transaction. So first one is LTV, stands for loan to value. It's the percentage of the property value that's going to be financed. So we always want to see the lower the LTV, the better in terms of getting loan approval. Second one is DTI, stands for debt to income. It's a ratio of your client's income that is allocated to their monthly obligations. And like the LTV, we want to see as low a DTI as possible, helping to get your client's loan approved. And the third one we'll talk about is FICO, stands for the Fair Isaac Company, kind of the developers of credit scoring. So a lot of people just call credit scores FICO scores, and we want to have the higher FICO score if possible. So if we have an acceptable LTV, DTI, and FICO, and they all meet the lending guidelines, well, more than likely we're going to get your loan approved. And those loan guidelines are typically established, at least for conventional loans, by the FHFA, which some people refer to as FUFA, and have a hard time saying that, but it's the Federal Housing Finance Agency. They oversee Fannie Mae and Freddie Mac. Fannie Mae, the Federal National Mortgage Association. Freddie Mac is the Federal Home Loan Mortgage Corporation, and they establish all the conforming guidelines. Now, let's not confuse them with the three government-insured loan programs. VA, your Veterans Affairs program. We have FHA, which is the Federal Housing Administration Loan Program, and USDA for our rural programs under the U.S. Department of Agriculture. Now, all those programs I mentioned all fall under the supervision of HUD, the U.S. Department of Housing and Urban Development, and they establish lending rules for all residential transactions. Now, if we have a loan officer that can't comply with those rules, that thinks that they are above the law, well, guess what? They're going to have to answer to the CFPB, the Consumer Financial Protection Bureau. They have the power to go in and remove the loan originator from the NMLS, which is the Nationwide Mortgage Licensing System. And if that happens, then the loan originator loses his JOB and will no longer be originating loans. So there you have it, a quick rundown of some of the more common acronyms and abbreviations that we use a lot in our industry. Okay? Hope you have a great weekend. Thanks for watching, and we'll do it again next week. And remember, you can't make the shots you don't take, so get in the game, call for the ball, take your best shot.